Hello guys and girls, and welcome back to AFT. In this lesson we're going to be focusing on the refinement of these 15-minute flags. Now in lesson 1 you would have seen that overall top-down analysis, understanding how to truly master the basics and realizing that everything is connected, and once you can do one thing very well you can then refine and do everything well. And this is what it's really about, using it in the right moments. So I have plenty of examples here for you to go through, so make sure you go over these lessons. So even lesson 1, go through that multiple times. You want to master this. You want to be moving towards becoming unconsciously competent at understanding how to use the refinement, and then you will see your results flourish. So we've explained CAD Swiss and all of the details all the way throughout. And to recap how many positions we had number 1, we had number 2, and we had number 3. You wouldn't have taken the reduced risk entry on this particular one because you would have been trading into that low. However, 1, 2, so you've got the reduced risk entry on the 5-minute flag. You've got the risk entry refined on the 15-minute, and then you refined on this entry, which is the more advanced one, on that right shoulder. Ridiculous return. So if you add them up, roughly it was around 5.5% plus this one here for around 20. You're talking 25-ish% on a run to the 90% rule. Very simple, nothing complicated, nothing fancy, just understanding the basics well. So let's move on to these positions. We're going to start off with CAD Yen. So CAD Yen, higher time frame. This is where we would use the refinement. So pay attention to the small details here. So we're at a significant high. So notice again, we're using this at tops and bottoms of structures. So at the top of the structure, we're at a weekly high. Naturally, we would be looking at this as a high value area for buyers to be getting out of the market, actualizing those gains, and then of course selling off. So then we would see who's going to be positioned there. It's the banks, the institutions, the funds, and we want to ride those waves. So what do we see present here? Again, look at that daily reversal structure there. So we push to the downside, and then we're looking for continuation. Again, I want you to focus on continuation and continuation only. So we get granular, we work our way down, and we take a look at what is happening within here. Now, this is very, very important, because when you work your way down, you have to be granular and see the bigger picture all the way through so you can understand the context behind where you would take a position. So 4 hour looks clear. Let's take a look at the 1 hour. Now, this first trade is very, very important because at the time, there was a potential for price action here to be moving into a bull flag. This could have been moving into price move up, move down, and we could have potentially started going high. Sometimes we see at high value areas, price creates left shoulder, it pushes up a little bit more, then comes back down, creates the right shoulder, and then it sells off. So we was ready to that. You know, not being attached to a bias is important. We will all have some kind of bias. It's the art of not being attached to it is what you want to focus on. So what we was looking at is this. If price breaks this area with momentum, which we have there on the 1 hour chart, that then negates this move to the upside. Therefore, that is where high up in the run we can start to use the refinement, because it's in the right area where we can look for two things: refining 15-minute flags and 5-minute entries as standalone independent flags. So we go to the 5-minute, let's take a look. So the 5-minute high up in the run, so we've negated that move, we're trading below this low. I'm going to remove this ray line here and make it more simple so you can actually see it. So you can see that clear flag below that low. So how would we look to take that? We would set our entry. This is your tight consolidation. So this is what I'm talking about, where you wouldn't really see it on the 15-minute. It wouldn't be as clear. But the context behind it, the 1 hour had already impulsively broke and there was a flag below the low. We all know how profitable these type of trades are. So let's say you set your entry on the break of this structure. You would have your stop loss roughly either just above there or anywhere around here. So call it 22, right? That would be fine. Remember, you're not always going for that 10 pip stop. It's not always going to be relevant. Now in this scenario, let's go back to the 1 hour chart so we can see. So we get tagged into the trade like so, roughly there, 1.5. You could have moved it to break even potentially, and then we move back up, and then here this one keeps you in. But the point I want to make about this is that this one is arguable. It could have so easily taken you out. So I want to go straight back to the 15 so you can see here. It wouldn't have been uncommon for you to have a slightly tighter stop loss. So this is one of those ones that more often than not with the spread, you might have actually been taken out. So let's kind of factor this one on as the loss, right? So let's say you took the loss in this scenario. If you took the loss here, then you just understand that, right, if you didn't move it to break even for whatever reason because your stop was a little bit wider, etc., well then you took the loss and there was a potential for a re-entry. But you've got to understand that sometimes taking the 5-minute flags, they are going to take you out for a loss, and you'll realise that if you weren't involved in them, you could have waited for the 15 and it might not take you out for a loss. So just understand that when you're introducing something that has the ability to increase your returns, me saying that it doesn't compromise our risk doesn't mean that you can't take a loss. It's just overall we have not compromised risk. So just be prepared for that as well. I don't want people going in thinking every 5-minute flag is going to be gold dust and it's all going to work. But can you see how here on the 15-minute it's quite wicky, but then on the 5-minute, as you can see, it's clear. You can see there's a clear flag there. This one, let's say you did take a break even or you took a loss and you was a bit more looser with your management, if you like, which could have been very normal. What did we have here? We had price. This is a bit subjective there. It's not so much that I'm looking for. It's more this parallel channel. But you can see we've come back to that previous correction and then we've rejected. So if we go to the 15-minute, you can see that there. So you can refine that a little bit further as we move up. We're then looking for the 5-minute to see if we can refine. Can we refine? Yes, we can. So let's say you got involved here. 17 pip stop. Price come back up. You wouldn't have moved that to break even at that point. Highly doubt it, just because it hadn't really moved away from the structure. Just because something's technically at 1% doesn't mean you just straight away move it to break even. It doesn't work like that. That's not really moved away. So we've come back up. You would have stayed in the trade. And then again, we go to the 1-hour chart for management. And we would have seen a break. You would have been able to move it to break even after we broke the structure. We then hovered. You would have walked away. Depending on that one, you might have ended up getting out roughly here. If you stayed in, let's see, yeah, you probably would have walked away at top end roughly somewhere around there of like 11 to 1. So still a decent trade overall, but you got to understand sometimes it's going to be a straight 1% loss, and that's fine. You know, it's not always going to be perfect, but high in the run is where they're the most profitable. The ones that you're more so going to do well on are the ones in which that you've got a tight 5-minute flag right at the top and they literally just drop out, and you can manage it so smoothly, so easily. What I've done here is I've showed you different variations of examples rather than you just seeing this perfect one hit wonder trade. Doesn't work like that. It gives you variation. So now let's move on to the next trade. Remember what I told you to focus on? Those 15-minute type flags that you can refine. So if you just look at this in isolation, let's just remove all of price action here. Even let's remove this for now, so don't want you to get distracted with that. Let's actually just look at this flag. Let's put the weekly back on so you can see. Take a look at that. Right, so we're high up in the structure. You're looking for this run. We're on the daily chart. We've moved to the downside. 4-hour chart. We've got some momentum there. We can get granular. Then we're on the 1-hour chart. This is where it gets interesting, because technically you could almost say that's a 1-hour structure. 1, 2, 3, 4, 5. It's borderline, right? It's very squeezed. It'd be easy for you to not see that. So the 15-minute would filter that. And you can see this is more of a 15-minute flag. So you can go two ways on something like this. You can either go reduced risk entry, which would be your typical entry like this. You're looking at 25, that wouldn't be unusual. Take a trade like that. You would have ended up walking away if we go to the 1-hour chart. Pullback that steep, you would have likely have locked in a bit of profit and ended up walking away with maybe 1.8, something like that, maybe even a little bit less. Call it 1.7ish. That would have been fine. You would have walked away and realised it just pulled up a little bit too much and wasn't willing to hold through that, because at that point it would have been all the way down here. You wouldn't just leave that all the way open. However, so now you can see that you was tagged out here. Let's refine the entry further. So we go to the 15-minute. Can we see, can we get a risk entry within the 15-minute flag? Well, this is where the 5-minute comes into play. Now, originally, because I've drawn this in already, you could try to look for it, but you could understand why maybe you wouldn't get involved within that structure. However, this is where the 5-minute basically gives you a bit more clarity, so it refines it further. So let's go 5-minute. Let's take a look at the entry. Look at that. Look at how clear that now looks on something, remember, you were already looking at, so you've not started to search for all these extra positions. You can just see it for what it is. You have an inner channel there, so instead of your entry here, your entry is now there. How does that change things? Well, it changes it to, again, you can go to 10, but let's call it 12, right? And then we're going to go back to the 1 hour chart. 1 hour chart here, so 2 ways, roughly, like we said, we was talking about 1.7-ish. Right, top end you might have got a little bit more. Call it on average about 4.5% here. So you've gone from taking the same thought process behind the trade in terms of the weekly time frame, etc. And all you've done, this is why I said, don't worry about reversals. Look at this continuation. All you have done is refine that 15-minute flag using the 5-minute, and now suddenly that's a 4.5. Let's say for whatever reason you was looser with your management, and let's go all the way out for you to see the trade. And you was holding a little bit more loosely because it is the higher time frame, chances are you would have got out roughly at that point. I reckon you would have got tagged out around there. So call it 9ish%. If you were super loose, then of course you had the bigger return. However, you can see it there. It was very, very simple. You've not had to get involved in anything complex. It's not a bigger structure. It's refining something that's already there. But can you see how on the 1 hour that you could easily miss that? And that's why it's refining in the right area. You've not tried to refine a 5-minute flag here or a 15-minute flag here. You've done it where? In the golden run again. That golden run is where you want to be. So now let's look, because I still want to show you these entries even though you're not going to be taking them straight away. So that larger 1 hour structure, as you can see here, is not, you know, the cleanest or the clearest, but it has context to it. So let's take a look. It's more of almost like a wedge, if you like, but it is a continuation pattern. If we go to the 1 hour chart, you can see that that is a larger structure. That's actually a very healthy continuation for the next leg down. That's built enough volume to go lower. I'm sure you'd all agree with that, right? Then we go to the 15-minute chart. We want to make more sense of that because we can filter from the 1 hour to the 15. Now this is where it gets interesting, because you can pattern separate in the right moments. Forget about this overall larger structure. I'm just going to go more granular because that's where my entry is within that 1, 2, 3. So I've not forgotten about the fact that this is the structure. I'm just showing you more precisely now what is more important in that moment. So now if we go 5-minute in the right area, we've refined. Let's see if we have an entry. We're not always going to have an entry, by the way. It's just to showcase. We get a bit of rejection. In all honesty, the 15-minute would have been absolutely okay in this scenario because we're playing that area. We've got the rejection of the 1, 2, 3, but roughly you'd be able to get involved, and the 5-minute might give you a bit of clarity. I wouldn't say this is your perfect one, and this is why I want to show some variation, that not everything is, you know, amazing. It's not going to work like that. But let's say you was involved here, you was able to filter that, refine that a little bit further, and then you probably would have ended up walking away with about another 5%. If you managed it more loosely, maybe a little bit more. But can you see these subtle details that you might not even be looking out for? Because maybe in being a bit too much of a perfectionist, that does happen as well, and it's normal. But once you get more and more comfortable with this, it will be so much easier for you to execute on these positions. So that is CAD yen. Let's take a look at Aussie dollar. So Aussie dollar on the higher time frame. So this is nice and simple for you. So where is this good to use it? Now I want to explain something as a lesson for you. High up in the run doesn't always just mean right at the top and right at the bottom. What it means is early on in the move as possible. So when you're just starting out, yes, I want you to focus more on refining those 15-minute flags right at the top, refining those 15-minute flags right at the bottom, and the 5-minute entries. I want you to focus on that more. However, this particular trade in Aussie dollar had a lot of context to it because we had this daily double bottom and we've got this near miss. So we've got that gap to fill. On the 4 hour, you can see we've pulled back nicely. We've got a larger 4 hour structure. And then on the 1 hour chart, you've not traded the 4 hour structure per se. What you're looking at is a push down and a flag. So you're trading the continuation. You're not trying to get a reversal right at the top. And then on the 15 minutes, as you can see here, this could be so easy for you to not take. Now, in hindsight, that looks obvious. You could go, right, yeah, I could see that trade. Think about the reality of it. Price pushed down, it pushed back up. It could almost look like it was creating something like that would keep you out of the trade. However, this is where the refinement would come into play. Look at that 15-minute candle. That 15-minute candle had moved up and rejected and already closed below there. If you weren't by the charts and it moved a little bit lower, you would have seen price down here, and you wouldn't be then taking it there. You would have think, right, I'm a little bit too late, I'll leave it and then wait for something else. However, if you could use the refinement in the right moments, once you're a bit more skilled, you can actually see the sections. You know, you can see that price is here, you've got a bit of a section there, you've got an element of a 1, 2, 3. In this scenario, after that 5-minute retrace, you wouldn't really take it there when it's so close to the low. So all this one would have done is confirm the move of the break of the structure that you would already be looking for. So for example, those trades in which that you think, I'm going to wait a little bit longer, you forget to set the entry, the 5-minute refinement is going to help you with that. So that would have given you more clarity to say, right, I can see the structure, and now I'm looking to get involved. I would like to filter that 15-minute on the 5 at the top, but if I don't get it, I want to make sure I've got an order set anyway. So let's say you got involved with a 12-ish pip stop. You would have walked away, again, management, 1 hour. You'd have walked away here with, roughly by the time you're out, you're talking about 6.8-ish%. Simple. You see how the refinements come into play there, how you could easily just dismiss all of that where we had context behind it. Now we're going to the next position. This one is a little bit more tricky, but just to show you, if you was looking at this next trade after this had dropped, it wouldn't be unusual for you to see this as a structure to give us, you know, a 1 hour structure, and you try and filter that and look for that trade to the downside. However, failed to see that refined to the 5 minutes, there is context behind it. I know some of you did actually take this position that are already using it. What can we see? We can see running channel. We can see price breaks to the downside, and we form this very clear structure there that you've got enough time to get involved in. Now you can go ultra tight, which I wouldn't recommend on something like that when there's the high there, so you would have given that just a bit of room to breathe. So right, even a 15 pip stop would be more than enough, and then when you would have walked away roughly again in the same sort of area by the time you're out, about 4.3, maybe 4.4, so more than enough. So look at what you've been able to add versus how many trades have you seen that you've looked at a higher time frame, it's actually gone in the run you've expected, but you didn't get the first trade or the second trade, or it just didn't quite form the full trade, and you didn't get involved. And that's what led me to actually seeing the refinement in the first place. So what would happen is things like, let's say we see a continuation pattern like this, and we're looking for that 1, 2, 3. What would happen is price would move up almost halfway, and I would be looking for this 1, 2, 3 risk entry. It didn't quite get it, and it would literally just drop out and think, oh, price is down here now. It moved in continuation. I wasn't able to get involved. And then when I started looking at refinement, what did I see? Price would get near there. It would break the low, and then there would be maybe a tiny little start of a 15-minute flag that just didn't hang around and dropped out. But on the 5-minute filtered below a bigger structure that already has the volume, that come into play nicely. I'll show you that on one of the trades in just a second, just so you understand the context all the way through. So this is a little bit more advanced. Like I said, you don't need to touch that straight away. You can be looking at the ones higher up, and once you know what you're doing, I mean, the world is your oyster. You'll seriously start to see the numbers increase. Now let's take a look at pound yen. So the next example for you. So pound yen. Pound yen is essentially teaching you everything you need to know about the refinement. It is phenomenal. Right, you probably see up here weekly performance sheet, by the way. That's going to be in lesson 3. So I'm sure you're eager to get that. That's going to be an ongoing resource that's going to be really helpful for your implementation of the refinement. So now we can see pound yen. Think about how brilliant pound yen has been all the way from the top. So what have we got? There's context. Again, mastering the basics is what I want you to drill into your mind. What have we got? We've got evening star formation, but the right side of the evening star ends on a hanging man. Now, that's not very decisive, so no wonder prices move back to the upside. We then have that weekly bullish high test, followed by a hanging man on the weekly. So what's the chances this wick gets filled roughly in that area? It's probably quite a high chance, but let's take a look at the original entries. So we get to the daily double top, very simple. We have 3 daily candles. You can see each daily candle is marginally smaller than the previous daily candle, so you can see that we're starting to slow down mathematically, and then we end on a hanging man in the right area of value to sell off. Look at the candle shape beforehand. We had this kind of evening star formation previously. We sold off. So we're getting that same type of formation there. So no wonder we was looking for trades at the top. So now again, we're high up in the run. Where is it most appropriate to be using this refinement? We're going 4 hour, we can see rejections there. We then work our way down, top-down analysis. We go to the 1 hour chart, and this is where it gets interesting. As you can see there already, you can already tell there isn't any trades visible that you can see. You can see there's consolidation, but there's no trades that you can actually see. The only ones you can see is you can make that out as a 1 hour structure, you can make that out as a 1 hour structure, and you can definitely make that out as a 1 hour larger structure. So we go 15 minute, let's see what we've got. If I removed where they are, it would be so easily for you to not really see them, or they would be very early so you'd miss them. The only one that you can see a lot clearer is this one at the top. So you've got left shoulder, head, right shoulder. So let's get this in. We've got left shoulder, head, right shoulder. This is where you want to filter. This is the money one. Again, this is the golden run. This is where you want to be involved. So essentially what happens, what I was explaining to you before, which is why you see this repetitive price action. Pound yen is notorious for head and shoulder patterns at the top and the bottom of structures. What do we see at the top? Head and shoulder pattern. Orders being stacked, right? Orders being stacked, boom, drops out. And then what's happened is a run like this has happened. You've not been involved in any of it, and then prices just pulled back. And it's like, oh, okay, I wasn't able to get that. But there was entries. And spent a long time refining these. So now we'll go, again, what are you going to be doing? You're going to be refining the 15-minute flag right at the top. So you can make sense of this one and say this one at the top is a 15-minute flag. So we're going to refine that to the 5-minute. As we refine this entry to the 5-minute, what do we have? Left shoulder, right shoulder, 1, 2, 3, as you can see. This is more of an angle like that, and it gets a kind of mini override there. But look how clear this is. This is what I was actually focusing on, but wasn't able to get it because it was just a bit too early. I woke up around 5:15, so it was just a bit too late for me. Now, if we get our entry on, this would have been literally go-to, especially after that override. There's your entry after we just start to reject. Remember, structure first, candle shape secondary. If we're just rejecting, don't wait for this perfect 5-minute candle. It's a rejection you want to see in the right area, and can you protect your stop? It's more risk management, right? So if we're looking here, 12 is fine. It's above that area. And then we're looking on the 1 hour for momentum. Now remember, if something just literally drops off the planet of the Earth and you're in a sell and it's down here and you're running 20%, don't wait for a pullback to then trail your stop. Move it 50% minimum and then start to get it more aggressively accordingly with price action. Now that's a good position to be in. If you're thinking, I don't know how to manage this 50% position, that's a good position to be in, guys, right? So take your time with that. However, right, this one you would have ended up managing on the 1 hour, you'd have walked away with 7.5%. So that's 7.5% that is not in your account, that could be part of you growing. Now the reality is, what could that contribute towards? Passing your assessment, scaling up, doubling your account to the next stage? Who knows? The reality is, even on my overall thought process is, even on 100k, once you know how to use this content I've spent over 1.5 years building. And you might think, well, it's simple, I understand, it's good, I'm glad that you're following along. But once you get it, it's not going to be unusual for you to hit on the months when they just are explosive, 20%, 25%. Now that will be the difference, you making 20k after your commissions, etc. on a funding firm, or maybe 18k or whatever it is. That's life-changing for so many of you. That is the ticket for you out of your job, doing this full time on 100k. Which is small in this industry, let alone when you're on 250,000, 300 and more. Right, I don't want to digress because I want to flow with these entries, and there's a lot here, but we wanted to take our time to make sure you understand it. So that was entry number 1. Very, very simple. You've refined a 15-minute flag using stop placement in the right area. Brilliant. 7.5%, beautiful trade. Now we look to the next one. So this is where, how many candles do we have? We have got technically 1, 2, 3, 4. So there's no chance you would have got that. You would have just been waiting. It didn't give you enough candles, so you didn't get involved. Let's see if the 5-minute has got anything to say about that. So the 5-minute chart, which was a trade that I got involved in. So what do we have? Can you see how on the 15-minute that you wasn't clear? Look at the sections. This is where the 5-minute is going to paint a clearer picture for you. So you can see that. 1, 2. You can take that as a reduced risk entry. This wouldn't be your risk entry. This is more of your reduced risk. You could kind of get away with it, but more so, this is your risk. This is your reduced risk entry. That is your risk entry. That's very clear. 1, 2, 3. Time that at the top. This is your reduced risk, and you'll be getting involved roughly anywhere between 20, 22 pips. And you would have got out at the same sort of place, roughly. You're talking 2.5%. But this is a trade that you was involved in 100% of nothing. So it's still another 2.5% of a structure that didn't work out. What is the difference if you finishing on break even or 2.5? What's the difference if you finishing on minus 2.5 or break even? It's very different for your confidence. So don't underestimate even these smaller positions. They add up. I have to go back to the 15-minute now. So when we go to the 15-minute, it's the next section. Remember, we're in the golden run at this point, and use your common sense in the point of view as you might be asking, okay, so how many trades down can I take 5-minute flag? It's the same thing as the 15-minute, so don't do anything different, right? You're not going to be taking, let's say we get a push, we get a tiny little 5-minute flag, push down, 5-minute flag, push down. Chances are eventually we're going to start to develop a deeper structure. So you don't want to be, 9 corrections in and you're still trying to take a tight little 5-minute flag. You just want to use it in context the same way you build other trades, right? We generally speaking, we get 15-minute flag, maybe another one, and a slightly larger 1 hour, and then we start our larger flags. All it means with the 5-minute, you might just get an extra 2 corrections or sometimes an extra correction within that run. So instead of 3 flags, you might get 4. So use your common sense and test with that. There is no perfect sequence, because the market cannot be that systematic that it's always 3 or always 4, but roughly there or thereabouts is a guide for you. So as you can see, we then break this low of this correction. We can see that corrective structure like so. And then we're looking for flags below this low. So again, this one was taken in the live session. Well, I actually missed this by a fraction of a second. However, look at those wicks. That would be very easy to put you off, right? But we want to clean this up using the refinement. So as you can see, that's very wicky there. Let's go to the 5-minute and see if that cleans it up. What do you guys and girls think now? Can you see that now? Let me move that out of the way. What have we got? Very similar to this structure. 1, 2, 3. I was looking for a risk entry up here. Was getting very, very close. However, opted in for the reduced risk entry and literally missed it by a second. Many people in the community took this in the live session, would have ended up with a break even. However, that one was very close. We was looking to refine. Let's say we did get the refinement and we was able to get involved with a similar type thing, 12 pip stop. And by the time it comes back up here, you're at 1.8 there. So this is an example of something where you technically could have been involved in that, and you'd be running 7.6% in how long? 7.6% in an hour, right? So in an hour, you're running 7.6%. This is where you have to use your initiative of, you're not just going to let 7.5%. Sometimes it's going to be 12% that you're running in profit, and if you're on a funded account, you'll literally see, even on 100k, you have like 12 grand running. You're not just going to leave it. So that's where the 50% rule comes in place. So you could lock in 3.5, and guess what? If it pulls back, tags you out on something that would have normally been a break even, on a trade that hasn't worked out, you've still banked yourself on a 100k account, 3.5k, or maybe 4k. Well, you can walk away that day, say, right, I've made 4k for the day, move on to the next trade. As simple as that. And if that's on a 200k account, you've made 8k for the day. You see how this starts to become life-changing money? So that is those trades there, refined. Now I want to move on to the larger structure, which, remember, you will avoid in the earlier stages. I just want you in the golden run first, and then we will move on to the larger structures. Those of you that have been using it for a while might have already got more comfortable with this, and you will be catching those trades. What I'm saying is, don't not shadow trade them. I'm not saying don't test them at all, but in order for you to get good at these, so you're not over trading and taking unnecessary losses, you need to know this first. That is the problem with most traders. They cannot follow simple instructions, and they don't build the foundations in the right way, which is why they don't succeed. It's the very reason why we've had people, capable traders, not succeed, that were very intelligent, they knew their stuff, but they just didn't listen and pay attention. It's as black and white as that. And those that do, I promise you, you will scale up to more capital than what you've ever seen in your life, potentially this year and beyond. So let's keep this very, very focused, guys. So as you can see, the larger structure, how could we apply the refinement? You can see we've got the 1 hour rejection entry there. and then we've got a bit of a retrace. So you can technically see that on the 1 hour. We would then go to the 15 minute, see if we've got anything in here. Okay, so larger structure. Right, so this is interesting, because if we go to the 5 minute here, what is important about this, so knowing when to use it, when not to use it, the 5 minute technically gives you a little bit of a clue. So if we just take it back to roughly around here, the 15 minute, in my opinion, was more than enough. It rejected, there's a bit of a flag. It's nothing too crazy. What's more important is that we've actually got your typical 1, 2, 3. So we've got the 1, 2, 3. But on the 15 minute in this scenario, sometimes what the 5 minute will do is just kind of confirm what you're already seeing. So you saw that tiny little consolidation on the 5 minute. What you was really interested in seeing is that it's a 1, 2, 3, the 15 minute wicked above. So that's washed all the orders out, and you're at a 3-touch structure. So you want to be getting involved on the break, and then you can have your stop either cropping through it or just above, right? If you're a little bit more conservative, I would personally go through it because I've got the experience, and then I'd be looking for this trade like so. So I'd refine it a bit better. So instead of, let's say, a 38 to a 40 pip stop, I've been able to get 22. It's a big difference in return, right? So as you can see, that would have resulted in roughly an extra 10.5% just by refining in the right way. Now this is the last part of this pair that I want to explain to you. So you see how when I was talking about trades in which we get a push down, we get a larger 1 hour flag, but on that third touch that it approaches, it only gets about halfway up, and then it drops down, gives a little flag underneath, and all of the volume that's been built up here essentially carries that trade, and it gives us another little opportunity just below it, but it never gave us that third touch that we were looking for. This is a similar example, but on the other hand, this one does give us our third touch, but still gives us that opportunity. So let's say you missed that trade, you missed all of this, and you don't want to take this on a reduced risk entry because you'd be talking, something like that of a 90 pip stop. The risk to reward, you naturally just not opt in for something like that because you can be tagged in, tagged out. There's so much margin for error there, you would stay away from that. So you go to the 15 minute and you can see, right, there's actually a flag forming underneath here, like so. But let's actually go back to price action around here. So if we go back to price action here, what would we actually have at the time? That would be 1, 2, 3, 4, 5. It would be forming almost just enough. It's kind of retesting it. It's through it, so that's okay. Again, you got the one more candle there. You could argue, well, I'm going to wait for a little bit more because we could get something like that, and I want to try and be involved here. Fine, I totally understand it and get that. This is where we're filtering the messier one that I spoke about. We're filtering the messy 15-minute flag with the 5 minute. And then what have we got? We can actually make context out of it and see, no, there's actually structure there. Right, and we can see there's a clear flag there. So I can get involved on the break, like so. Either as a reduced risk entry, like this. Right, slightly bigger stop, fine. You can get a reduced risk entry. Or you can get involved at the top. This one is a little bit more of a rejection. It's slightly more aggressive of getting involved, but again, once you really know your stuff, you will be able to get involved in some of these type of positions. But the point I'm making is this. Let's say, how do we play out? So if we go to the 1 hour chart here, we start to sell off. Can you see how on the 1 hour it looks like nothing? It's broken, you've missed the entry, missed the entry, have to wait for either price to maybe break this low and come back up and create a larger structure, or the trade just goes. However, there was an entry, and it's the one here, but the 15-minute would be so easy for you to rule it out because it was only just enough of a 15-minute messy flag. But the 5-minute was a nice refinement because it had context and it was in the right area, you see? Right, so by the time we would have got out of this one, it would be roughly, yeah, about there. So you would have walked away, depending on your stop size, 3.5, right? Sometimes could be 3.2. I'm just giving a random rough average per stop size. It's a trade that didn't really go. You missed that trade anyway, but you still walked away with another 3.5. Think about what we added up here. Another 2, another 3, right? You got 5 there, 5 there. Can you see how throughout the month on the bigger trades that you missed, but yet you was able to add another 9 to 10% collectively? How much value is that worth? So that is the kind of mindset that I want you to be in, not just focusing on these ridiculous returns where you've caught that one run and made 20%, which will happen, by the way. However, don't underestimate the power of just banking these small little wins by just refining the 15-minute flags using the 5-minute. It is as simple as that. So far we have CAD yen, Aussie dollar, pound yen. Now let's take a look at something a little bit different on pound Aussie. Right, guys, so this is pound Aussie. So this is a simple example. This is actually a trade I was involved in, but I want to give you a bit of context as to how this could help with using the refinement. Now, if we go to pound Aussie in this area, what do we have? We have that daily double bottom, we have that push up. Naturally, we were looking for long continuations. On the 4-hour chart, for those of you that got involved as well, you remember that we got this push up, kind of an inverse head and shoulder, push above here, and we're looking for entry points. On the 1-hour chart, as you can see, we've got this horizontal flat flag. Now, this is going to be the difference once you know what you're doing, which is why I want to explain it. You can use the 5-minute in these areas once you're clear on how to operate within these boundaries. However, look at the precision of using the 5-minute in the right area. Right? You could argue you could have potentially got involved in there in the 15 as well, but the difference would have been this. Let's say you waited for this rejection candle here and you was involved roughly about there. And you had your stop below. That wouldn't be crazy, you know. Even at 30 pips, that wouldn't be crazy because, you know, that's more than enough protection. You would have got to technically 1.3. You would have moved that to break even. Price would have moved down back into the pattern, so you definitely would have moved to break even, and you would have taken a break even and it would have gone. Sometimes that happens, right? It's happened to the best of us. But by refining it on the 5 in this scenario, and this is what I'm explaining to you, that certain scenarios like this will happen in which that you usually would have taken a break even, you was able to refine it so your stop placement is not so much better, but it's refined so your entry is more precise. So as you can see here, you'd have been able to get involved roughly around, let's go to it, and this has been ultra precise, so don't worry about getting perfect at this stage. You may have just stayed in, like literally by a fraction of a few pips. It would have been one of those ones that you might have got taken out by spread, or you stayed in by about 3 or 4 pips. Means you can refine that a bit more, talking about 18, and then by the time you're out of the position, refining using the 5, giving you rough different examples here, that you're either out roughly around here for 5, or if you held it a bit more and was more lenient, you'd have got out roughly about 11 here. But do the more conservative 5%, nice and simple. But that would have been a break even, so how would that be for your month as well? So it just goes to show you that using it in the right area will stop those scenarios happening as well, just because your entry is a bit more precise. So the ones that have come back to tag you out for break even and then they still go in the direction that you forecasted, some of those will end up in profit as well, which again will make a massive difference to your performance over the quarter and over the year. Now let's move on to dollar CAD. So dollar CAD was a lovely, lovely refinement. So this is another example of how you can use this. Wanted to go through quite a few examples. So this would be an example coming up, right? We're looking at dollar CAD for the sell here. Once you know what you're doing, you can look for a 5-minute once we've got confirmation in and around these areas. The push down, a 15-minute flag, filter that on the 5-minute. You can apply that. But if you can't get the simple things right, you can't be moving on to these larger structures, which leads me on to what I said for you to focus on in the first place, which is so simple. We're right at the top of this structure. We just go zoom out to the 4 hours so you can see the bigger picture again for those of you that are not familiar with that pattern. What have we got? 1, 2, 3. We've broken above this double top. We've broken above this double top. And we're looking for that early golden run. So if we go to the 1 hour chart, you can see high up in the move what we're looking for. I actually missed this entry. This was just after I went to sleep, I believe. So we had that 1 hour push down, and then we started to form 1, 2, 3. And on that 3rd hour, it's already broken, so you wouldn't have seen the entry anyway. 15-minute. Technically, this is a 15-minute flag and not a 5-minute entry. However, it would be so easy for you to not interpret what is happening here. So if we look at the 15-minute there, you could have easily thought, I'll just wait for a little bit more. However, we just place that back around there. And we go to the 5, you can see the clarity Right, you can see the position, you can see the sections. That's what I was mentioning before. You're going to see things that are a little bit unclear. You're then going to filter. Don't just jump straight to the 5 and overuse, but use it in the right moments. So as you can see, you've got clarity now. You can take that on the break. You've got more than enough time. Like so, you would have been able to get involved easily. Call it 12. Right, trickles around for a little bit, and then those of you that managed it a bit more loosely, well, I know many of you actually caught this trade and passed your funding assessments, which was awesome. However, let's play that out a little bit. So chances are you wouldn't have really held through all of that, not on larger capital anyway. So even if at this stage, I know some of you was a bit more lenient, however, the more appropriate higher scale, you would have walked away with roughly about 8%. Now, you could have been even more aggressive in the right moments for, 9.3. Like I said, just because it's 10, don't go to 10. Well, that was very, very nice indeed. So as you can see, on a trade that you might have just literally missed, not even seen, because you would wait for the run out 1 hour retrace, which we had, and then you might have waited for a continuation. Didn't really form. You was looking at the 15-minute thinking, oh, I'll wait for a little bit more, and before you know it, it's gone. But the 5-minute gave you a bit more clarity to the sections there and essentially filtered that out for you. So it is as simple as that. That can be the difference. If you think about the trades we've just added out, some of these trades that we've just looked at, these examples, are actually recent examples that have all happened within a similar amount of months, and that we've added 5% here, 7% here, 8% here. Can you see how effective this is once you know what you're doing? Last one, a completely different style of variation that will help, is the S&P. To kind of summarize this lesson, look at the S&P on the daily chart. The S&P, we were looking for break below this structure, a move to the upside, and we were looking for continuation to move higher, right? Then we go to the 4-hour chart. What do we get? We get a larger structure. Now, this larger structure would, generally speaking, be moving to the upside for continuation. But what happens instead? We get a strong 4-hour close, negating that bull flag to the upside that you can clearly see. Breaks below here, breaks below the ray line. On the 1-hour chart, you can see continuation starting to form. But remember, at the time, we would then be looking lower to the 15-minute. And this is where, on the 15-minute, 1, 2, 3, let's refine that on the 5, so it's in the right moment. You're refining the 5-minute, you're refining the 15-minute flag with the 5-minute. So what can we see if we get really granular here? We get the 1, 2, 3, and you get the tiny little override at the top, and you've got the rejections around this area, which means you can get involved with a risk entry because your stop placement is so simple. We're talking 20 pips up here, and you don't need that. So you're more than fine with 10, right? More than fine with 10. As you can see, you're protected. Everything is in place. You could go reduce risk entry as well. That could still come into place. So there were 2 entries. But the context behind the position was when a larger flag like this doesn't commit and it breaks impulsively to the downside, and especially below this little correction here, and then forms the flag, chances are it's dropping out back to its lows. So even if, let's say, you was going to take this trade and then close before the weekend, for example, it wouldn't be an unreasonable decision to manually close at a double bottom with this circumstance as a quick move. Well, look at that. It's 22%. 22% in a day, right, of just simply understanding how to refine in the right moments. Nothing fancy, nothing complicated, real simple runs. And that's exactly what is going to happen on a consistent basis. And I cannot wait for you guys and girls to be just flowing with these trades once you know actually how to deploy them. Take your time with it. Don't rush into the positions. But as you can see from CAD Swiss, CAD Yen, Aussie Dollar, Pound Yen, Pound Aussie with the one that would have taken you out of break even, would have added another 5-odd%. So you can see the difference in all of these trades. They can add so much to what you're doing. Now the beauty is, it's not changed a thing. Higher time frame, we're still reading price action the same way. It's refining in the right moments. But what it does to your performance is literally mind-blowing and life-changing to add. So guys and girls, go through this in detail. Lesson 1, Lesson 2, they're all going to build on each other. And remember, there's that ongoing support as well. So naturally, when more scenarios, more variations come up, we're going to be going through them. For those of you that are in the actual live sessions, we're going to have multiple examples of them live for us to be able to trade, interpret, and move forward as well. So there is an abundance of opportunity and support for you to get to those next stages. So that is it for refining those 15-minute flags using the 5-minute and understanding the bigger picture. There are so many valuable lessons in this. You're going to want to go over this lesson multiple times over, moving towards being unconsciously competent. Now let's move into lesson 3. So when we move into lesson 3, we've got the weekly performance, which we're going to be able to get into, the resource, so you can understand ongoing how you can actually implement this into your day-to-day trading. Cannot wait to get into it. See you in the next lesson.